The actual spending of a mortgage, about 35% of it will go straight to interest, and 65% will go to principal over time. And on average, the average mortgage payment and car payment, 35 cents of every dollar that is spent goes to interest. And so my responsibility here is to show you exactly what you can do. Now, in the first 5 years of a mortgage, on the first 5 years, 86% goes to interest. That means that 86% is going to interest, and only 14% is actually going to principal to pay principal down. And so it's super important to understand money. It's not about the rates of return. It's about the volume of the interest. Okay, so what does that mean? All right, and I'm just going to read straight out of this book. If you don't have this book right here, get the Becoming Your Own Banker program. Banker, which is like our Bible. All right, and this whole concept is all about volume of interest. It is not a procedure to get rich quick. In contrary, it requires long-term planning. The whole idea is to recapture the interest that one is paying to banks and financing companies for the major items that we need in a lifetime, such as our automobiles, appliances, education, homes, investment opportunities, business equipment, etc. It is not about investments. It is about how you finance the things in your life. It is also not about rates of return. As time goes by, interest rates go up and down, but the process of banking works hand in hand as time goes on. And I'm gonna put on the screen here. So look, I want to show you what I'm talking about here. So most people think about the rates of interest. Right? What's the interest rate? What's the interest rate? What's the interest rate? All right, and unfortunately, we've been duped by Wall Street. We've been duped by the bankers. We've been duped by the politicians to care about interest rates when interest rates are fugazi. Interest rates don't matter. It does not matter. I know it matters on your payments, whether it's a 3%, 4%, 5%, 6%, 10%, 20%. It matters on your payments, but it doesn't matter about the grand scheme of things, because when you understand interest and you understand that on $1 million home with 20% down for 30 years, even at 5% interest, which is not what it is right now. Right now it's 7 or 8% interest or more depending on your credit. But I want you to see here, all right, update. So if you look here, it doesn't matter that it's $5,000 a month. I know it seems like it matters to you, but in the reality of the situation, if you look at that here, this is what I was looking for. Amortization, look at this. Over the course of the 30-year loan, your loan amount is $800,000 and your total interest paid is almost $800,000, which means that yes, you have a 5% loan rate, the 5% interest rate, but in reality, you're paying, and I'm going to share my entire screen here really quick with you guys, just so you can see my calculator. This is how I think about money here. Just it's totally different than everyone else thinks about money. That means you're paying 93.25% interest. You guys can see the calculator on the screen, right? They tell you you're paying 5% interest. The reality is you've paid almost 100% interest. And this is a mortgage. And they call mortgage because root of mort, Latin, is death, right? And the root of gauge in Latin is to pledge. The word gauge comes from the word pledge. And the word, I didn't do this. I didn't type this in. This is Google's AI. The word gauge comes from the early German word for pledge and the Latin word mortus, which means dead. So the word mortgage is a combination of these two words and literally translates to death pledge. The concept of a mortgage is thought to have originated in early civilizations where property was exchanged with the promise to repay it over time. The pledge was considered dead once the loan was repaid, or if the borrower couldn't fulfill the terms of the deal. This is literally a death pledge, and you have to understand what that means so that you know what you're signing up to. And unfortunately, we grow up in a world where people care more about whether or not they can afford the payment than whether or not they're paying $800,000, $750,000 to outside investors. And so if you can understand the concept of interest and of money, then you'll understand the concept of becoming your own banker, because that's really what it all comes down to. And so if you can be conscious of money and learn one thing tonight, is that a mortgage is a death pledge. And if you go get $1 million home, and if you cut it in half, because $1 million is scarier to some of you, and you do $500,000, and even if you tell me that you got your home for 2%, right? You're still paying 25% in interest, more than 25%. 132,252 divided by $400,000. You're paying 33% to interest. And I know they told you that you're paying a 2% interest rate, but the volume of the interest means that you're paying 33% of the loan amount is going to interest, and they've duped you into believing that you're paying 2%. It's all fugazi, it's not true, and you have to understand this situation about money. And so to really break this down and understand the concept fully, you have to understand inflation. Now, according to Creature from Jekyll Island, which is right here, according to this book right here, The Creature from Jekyll Island, inflation is the hidden tax. So these are two situations right here. This is the banking system. Right here we have the Federal Reserve. The Federal Reserve was founded in 1913 off the coast of Jekyll Island, and you have two groups of people that were represented there. And this is so important to understand the ins and outs of banking industry, because you have the bankers and the politicians. We basically have people that were running for Senate and lobbyists for the government, and then the Rockefellers and the Morgans breaking down how to create a system where bankers make their money on interest and politicians make their money on taxes. And the question becomes, how can we increase both of these situations as much as possible? And the way that one does this is by printing more money. Now, most people think that inflation is the increase of cost of goods. And the reality is that inflation is the increase in money supply. And the more that you print money, the less value money has because of supply and demand. So if you just understand basic economics, you have supply and demand. So as the supply goes up, the demand goes down, and then the price point is going to decrease. And so as we continue to increase the supply of money and the demand goes down, the price will always be, $1 is going to be $1, right? $20 is $20, but what you can buy with those $20 is totally different. And this is the difference between nominal value of money and the real value of money. And you understand that every single time we print more money, which is happening at about $80 billion a week, this keeps going down and down and down and down and down and down. And so as a business owner, entrepreneur, real estate investor, your responsibility is to collect this money from other people and go get it out of your bank account as fast as possible, because it's not even your money. This is not your money. I don't care that it came out of my wallet. This is not your money. It's someone else's money that they gave you in exchange for value and service. And when you understand that there is no such thing as my money. There's no my. That doesn't exist. There is no my money. There is just money that's circulating out there in the world. And it's your value, it's your responsibility to put value and service out there so people buy your program, so people buy your product, so people give you their money because you gave them value. This is an exchange of value. And so the more that you increase the supply of money, which is happening at an ever-increasing rate, the less demand goes. And that's why you can go to the grocery store and $20 today buys you like, what was that thing? That thing of fucking watermelon was $20, right? You can buy one container of watermelon, right? You can buy one container of watermelon at Publix, whereas before a container of watermelon cost $5, and 40 years ago a container of watermelon would have cost $1 to $2. And it's because the value of $1 has decreased significantly over time. And when you understand that, then you understand how important the banking business is to getting back into the hands of you. And so the more that you increase the money supply, the more that you decrease the value, the more that you increase interest, the more you increase taxes, because every time you print more money, for every dollar that is created in the world, for every dollar they can lend out 9. Right, there's a 10% reserve ratio, so every dollar they print, they can lend out 9. Every time they lend out money, they can charge more interest. And every time they charge more interest, the bankers make more money. And if the value of a dollar goes down and people go spend that money, because that's what people do, then they're going to have to pay sales tax on that. And so the whole process goes where the Fed prints money, they give it to the government in the form of treasury bonds, or T-bills as they call it. The federal government goes and lends it to the people, and they call that a bond. In reality, it's a loan from the government to the people where they're going to give them back that money plus interest later. And then they're going to go spend it and then take their returns and go put it back into the bank. And the bank is going to go lend more money to the people. The people are going to go spend that money. They're going to take their returns and go put it in the bank. And when I say returns, I just mean their cash flow. I mean their income. Because as soon as you make money, you go put all your money in the bank. You immediately go give it and you put your own money in prison in someone else's bank. And so for some people, they think that the solution is to pay cash. Right? This is how, if you're anti-government and if you're anti-establishment, if you want to live off the grid, if you want to be a true sovereign citizen, well, you're just going to pay cash, because then you can give a middle finger to the bankers and say, well, I'm not going to pay you any interest. Well, unfortunately, it's time to wake up, because the reality is when you don't pay any interest and you pay cash all the time, well, you're just constantly making money, spending money, making money, spending money, making money, spending money. You never keep any for yourself. And so then you go question how you're supposed to build assets, and it's nearly impossible in the Federal Reserve System for you to create a net worth with assets paying cash for everything, right? And this is why, it's so important to understand money, because the intention is correct, right? But the end result is not what happens. The other solution is to borrow money. I believe in borrowing money. My favorite kind of money is OPM, which is other people's money. However, when you borrow money too much, now you're paying interest to somebody else, just like we talked about before. And so instead of paying interest to somebody else, most people only have these two options. Every time we call people, we say, do you pay cash or finance? When you buy a home, you're either paying cash or financing it. When you're buying a car, you're either paying cash or you're financing it. Right? Well, the reality is that when you do this, you're either depleting your savings and you're giving up interest you could have earned, or paying interest to somebody else. The other alternative is to understand this concept right here, that will put millions of dollars back into your pocket and leave millions of dollars behind to your family for generational wealth. And that's becoming your own banker. BYOB, not bringing your own booze, but becoming your own bank. And this is when you can pay cash into your banking system, gain interest for yourself, and then compound interest forever. And today somebody asked me, well, why would I want to borrow my own money? And you're not borrowing your own money. You're borrowing the life insurance company's money, and they're utilizing your cash value as collateral in a life insurance policy so that you don't have to deplete your savings and you don't have to borrow it. And this is from the infinite banking concept. This guy right here, Nelson Nash, becoming your own banker. And the whole idea, I read this sentence for you earlier, but the whole idea is to recapture the interest that you're paying to the banks and the financing companies for all the major items that you need, and to have that money flow back into your pocket instead of the bank, the government, and the Federal Reserve, because these three players right here, numero uno, dos and tres, because I'm in Miami, I'm learning my Spanish. All right, the objective for them is to keep money flowing into their pockets. My objective, and the objective of Nelson Nash with the becoming your own banking concept, the infinite banking concept, is to keep the money in your family. instead of their families. Right now, all of the money is flowing through the Chase family, the Morgan family, the Rockefeller family, all of these major families, the Rothschild family, these major banking cabals, these major families, these major bloodlines is where all of our money flows into. And so you got to understand a few golden rules here that I'm going to cover with you. Number one, you have to think long range. You must think long range because we live in a world where so many people think short range. And if you can think long range when everyone else is thinking short range, you'll be successful. Number two is don't be afraid to capitalize it. What I mean by that is if you're going to start your own business, you must be able to put more money into it so you can get that business off the ground. And if you were going to start a bank, you must also put more money into your bank so you can leverage that money. A bank only makes money when there are deposits. So if you're going to create your own banking system, you want to have more deposits, because if you have more deposits, you'll have more money to lend. And a banker makes their money on interest. So if you're becoming your own banker, then you would make your money off of interest as well. You can't change the function of banking, but you can change who controls the function of banking. So instead of dealing with other people, right, number 4, don't do business with the banks, you have to, number 5, which is to rethink your thinking, so that you can understand how to take this process that we do every single day, where we work our asses off all day long, all the time. Right? Most people work 9 to 5. I'm up at 4 o'clock in the morning every single day. I wake up at 3:45 now. At 4 o'clock in the morning and go to rest at 9 or 10 o'clock at night. And that whole 18, 19-hour day of production, I work my butt off. You work your butt off. All of you on this call work your butt off. And then you go take your paycheck and you directly deposit it into someone else's bank. And immediately give up control. And they go take your paycheck, multiply it by 9, and then lend it out to other people. Go lend it out to someone else that wants a loan for construction, wants a loan for a car, wants a loan for real estate, wants a personal loan so they can pay their bills. And that's how banks make money. And every time that you spend money, the government charges you a sales tax, and they make money, and they make money, and they control the money so that we stay broke.